Okay, thank you everyone for coming to this webinar today. My name's Cameron Kusher. I'm the Director of Economic Research at REA Group. And I'm here to give you a property market outlook as we head into the spring selling season, which, as we know, is generally a pretty busy time for the market. Hopefully these insights will set you up for the spring selling season and giving you an idea of what we're seeing across the Queensland housing market at the moment. Today, I'll be providing a housing market update, which looks at housing trends, looks at what's happening with buyer demand and inquiry, looks at what's happening with supply, and also talks to what we think is going to happen over the next few months. We'll also include an economic update in this presentation as well. If you do have any questions, please use the question and answer function at the bottom of the screen, and we'll do our best to answer those at the end in the Q&A discussion. These slides will be available, a copy of the presentation will be available afterwards on the Customer Marketing Centre. But I'm going to jump into things. So firstly, to start though, I would like to acknowledge the traditional custodians of the country throughout Australia and their connection to land, sea, and community. We pay our respects to their elders past, present, and emerging, and extend that respect to all Aboriginal and Torres Strait Islander people joining us today. Let's start off though with a look at what's happening in the national economy. I think one of the things that really hasn't been talked about so much is just how weak the economy is at the moment. On average, over the last 30 years, the economy has grown by 3% every single year. And that's obviously through fluctuations over that period of time. At the moment, the economy has increased by 1% over the 2024 financial year. Now, outside of the pandemic, where lockdowns saw economic growth, drop dramatically, this is the weakest annual rate of economic growth since the end of 1991, as we were coming out of that recession. On a per capita basis or per person basis, GDP has fallen by 1.5% over the past year and has fallen for 6 consecutive quarters. That's never happened before in the history of this quarterly data, which goes all the way back to 1973. So things are very weak. You can see there that over the quarter, GDP was 0.2% higher, and you can see the contributions to that change with government consumption, which is government spending, being the major contributor to the growth in the economy over the quarter. The national accounts also includes information on household savings and household consumption. So the household saving ratio over the last 30 years has averaged 4.7%. You can see that during the pandemic, savings really were boosted dramatically. It was very hard to spend. But right now, the household saving ratio is back at levels it hasn't been at since before the global financial crisis. So households are not able to save very much, which is not really a surprise when you consider how much the cost of living has gone up, how strong inflation is, and how weak wage growth has been, relatively speaking. And households are tightening their belts and spending less. So household consumption, which is simply spending, was up only 0.5% over the past year. Household consumption makes up 50% of economic growth. So it's really benign, that growth right now. Sorry. If we look at inflation is still a problem. Now, there's two inflation measures. There's the quarterly inflation measure, which is the older one. It's more holistic. And there's monthly inflation, which was published today by the ABS. It's experimental and it's not as broad. It did show that inflation is slowing, and the Reserve Bank does expect that headline inflation is going to fall back into the target range over the next quarter or so. That's largely because the state and federal governments are offering so many rebates at the moment. Now, rebates are great because they do lower costs, and we're seeing energy rebates here in Queensland. We're seeing public transport subsidies, 50-cent fares, which is great. And I think politically it's really good too. But the problem is, at some point, they're only temporary. At some point, they're removed. And when they are removed, they are inflationary. So yes, headline inflation will fall into the target range, But because these measures are temporary, it will then rebound out of that as well. And with headline inflation and underlying inflation up in the high 3% range, as opposed to the 2 to 3% range it should be in, inflationary pressures are still too high at the moment, and they're currently not forecast to come back into the target range sustainably until late 2025. Now, yesterday, the Reserve Bank handed down their interest rate decision for September. No change, a 4.35% cash rate, the same as it's been since November of last year. The cash rate's the highest it's been in 12 years, and obviously it got here very quickly. The expectations are that there will be interest rate cuts either very late this year or early next year. In my view, I think February next year is the most likely timing for an interest rate cut as things stand now, but obviously that can change. I think also we're likely to get several interest rate cuts in the next year. Turning to the labour market is where things are really strong. So the unemployment rate at the moment is 4.2%. It has been under 4.5% for 32 consecutive months. Now, to put that in context, between 2009 and 2021, there were only 2 months where the unemployment rate was below 5%. So the labour market's very tight, and we've got record high levels of employment participation sitting at 67.1%. So that means more people of working age are either employed or looking for a job, and we're creating a lot of jobs. You can see over the past year that employment has increased by 2.7%. Over the first half of the last year, most of that employment growth was in part-time roles. In the last 6 months, it's largely been in full-time employment roles. So the labour market is very strong, albeit the unemployment rate has drifted higher. Part of the story there, though, is that the population is growing so rapidly that we have to create a lot of jobs every single month just to keep the unemployment rate steady. Turning to the lending environment, so housing finance commitments are split into new commitments and refinances. New lending is up 26.5% from a year ago. Refinance lending is down 21.5%. Refinances are down because interest rates have been on hold for quite a long period of time now, but also a lot of people that fixed their mortgage rate during the pandemic rolled off early last year. So we've got fewer people coming off fixed rates needing to refinance. When we do start to see interest rates fall, I think we'll start to see more refinance activity happening in the market. In terms of the new lending, where is the growth? At the moment, the growth is in the investor segment. So investor lending is up 30% from a year ago, and the share of lending to investors is the highest share we've seen since April 2017. Owner-occupier first home buyer lending is up 11% over the past year, and subsequent buyer lending is up only 14%. Keep in mind, though, with subsequent buyer lending, downsizers are very active in the market at the moment. So if you're moving from a more expensive property to a cheaper property, you may not need finance at all, or you need to borrow less than you would when you're upgrading in the market or you're a first-time buyer. In terms of new housing, there's still a lot of challenges in this space, and construction costs are a big one. So there's two components of construction costs. There's the inputs, which are the materials, and there's the outputs, which is actually building what you're looking to build. So over the pandemic, so since March 2020, input costs have increased 34%. You can see they're only up 1.1% over the past year. So those cost escalations are certainly easing, but they're unlikely to fall. The output costs, though, you can see that both for houses and other residential, the annual rate of growth is lifting. So for houses, they're up 4.3% over the past year. Those costs are up 41.5% through the pandemic. Other residential, which is medium and high density dwellings, 7.7% growth over the past year, albeit those costs are only up 25% since the start of the pandemic. But all of these costs get passed on to the end user. It means that renovations are more expensive, but it's also contributing to new housing prices being much higher than existing housing prices. And for developers, it means it's a harder sell to get someone to buy your product. And as a result of that, we're getting fewer dwelling approvals. So nationally, dwelling approvals over the past year, there's about 165,000. under the federal government's housing accord, we need to be building every year for the next 5 years 240,000 new dwellings. So we're certainly not on target. Now, part of this is the cost of construction. Part of this is also where interest rates are at the moment. Higher interest rates mean developer finance is more expensive, construction finance is more expensive. It also means it's harder to get the pre-sales you need to kick off construction. And there's several other challenges around developing housing at the moment. And as a result of fewer approvals, we're getting fewer commencements. But there is still a lot of housing under construction, mainly due to the fact that everything is taking longer to build than it used to. So things are sitting under construction a lot longer, but that pipeline of new construction coming in behind has really thinned out. At the same time, though, the population of the country is growing rapidly and we need more housing. So over the past year, the population increased by 2.3%. That's 615,000 people. 85% of that increase was from net overseas migration. Most of the migrants coming are students. You're probably not going to be buying a house if you're a student here temporarily, at least initially. So this is putting a lot of strain on the rental market. And that's why we've seen rents increase so dramatically. So what do we think, and what's some of our views on how things are going to pan out over the next year? So the charts on the right, or the table on the right, is the current Reserve Bank forecast, and some highlights here. They do expect economic growth to pick up over the second half of this year into next year. I think that's reasonable, given we all got a tax cut in July of this year, given we're getting a lot of rebates, which is making it is helping at the moment, the cost of living. But also, it's less likely interest rates are likely to rise from here, and into next year, they're probably going to fall. And inflation, yes, it's still too high, but it is moderating. So that should see consumer spending pick up. We know government spending is quite strong at the moment. They are hoping for household consumption and business investment to rebound. Whether that happens or not remains to be seen. Inflation, we do expect that it's going to moderate further, but it is likely to remain outside of the RBA's target range. And that will mean that interest rates are probably not going to change this year. As I said, I think February next year is when we get an interest rate cut, and then we'll get several through next year. The labour market, as I said, is extremely tight. It has seen the unemployment rate rise from 3.5% to 4.2%. The Reserve Bank has a forecast peak of the unemployment rate of 4.4%. Given we're already at 4.2%, I think it's highly unlikely we top out at 4.4%. I think that, businesses will start to reassess how much labor they need. Businesses will slow their hiring as people leave roles. And I think we do get an unemployment rate closer to that 5% mark we were at pre-pandemic. I didn't talk about wages, but wage growth has peaked. For the last couple of quarters, in inflation-adjusted terms, we have got real wage increases. But the last couple of quarters, just on a quarterly basis, we've actually seen inflation stronger than wage growth. So whether we continue to see real wage increases remains to be seen. Dwelling investment is expected to continue to be weak until the middle of next year, and even then, the rebound is forecast to be modest. And the population growth is likely to slow from the record highs we're seeing, but it is still at an elevated level, which necessitates more housing to be built. Very quickly, the economy in Queensland. So the unemployment rate is bang on what we're at nationally. Over the last 30 years, Queensland has tended to have a higher unemployment rate than what we've seen nationally. We are creating a lot of jobs, a 4.2% increase in the number of employed people over the last 12 months. In terms of the lending environment, so lending is growing at a much stronger pace here in Queensland than it is elsewhere. You can see investor lending's up 41%. Remember, nationally, it's up 30%. Subsequent buyer lending up 11% nationally, 31.5% in Queensland. And first home buyer lending was up 14% nationally. It's up 35.5% here in Queensland. So a lot of demand for mortgages at the moment. In terms of housing construction, approvals have fallen a long way from their peak, particularly for apartments. There's maybe some signs that house approvals are starting to improve, but there's no real sign of any improvement in unit approvals at the moment. And as a result of that, we're still seeing very low commencements, but a lot of stock under construction. And then if we look at Queensland in terms of its population growth, really strong net overseas migration, as we're seeing right across the country, but still a very strong rate of net interstate migration. With housing affordability becoming deteriorating here in Queensland, though, I wonder if we do see that rate of net interstate migration starting to slow down over the next few quarters. So let's have a look at the established housing market and what we're seeing at the moment. You can see that the quarterly rate of growth is still positive, but it is slowing. So in Brisbane, prices rose 1.8% over the last quarter. In regional Queensland, they were up 1.5%. On the right-hand side, you can see how that plays out across the areas of Brisbane in the black and the areas regionally in red. Everywhere has seen some growth over the last 3 months. If we look over the last 12 months, you can see Brisbane prices are up about 14%. Regional Queensland prices are up about 11%. The standout regions have been the northern areas of Brisbane, Townsville, central Queensland, Ipswich is where we've seen the strongest price growth. But again, prices are higher everywhere. Brisbane's price growth is strong, but it's not as strong as Perth, where prices are up 23%, or even Adelaide, where prices are up 15% over the past year. But compared to Sydney and Melbourne, we are seeing stronger growth. Sydney prices are up 6% over the year. Melbourne prices are down 1.5% over the last 12 months. And then if we split things out between houses and units, so unit prices in Brisbane have increased at a faster pace than houses over the past year, whereas in regional markets, it's been the houses that have seen slightly stronger growth than units. Some of the unit growth in places like Ipswich and Logan Bow Desert has been quite phenomenal over the last 12 months. And then if we look at the premium for house and unit prices across the different areas, so in most areas, the Outback is an odd one. It's the only market, I think, in Australia where unit prices are actually higher than house prices. But you can see in Brisbane's inner city, a very large premium for houses over units. Similarly in the west and the south suburbs of Brisbane as well. I think it just speaks to the fact that if people want to live in these inner city areas, increasingly they're going to be pushed towards the more affordable, medium and high density housing. And it means we need to deliver that product in those areas as well. Turning to supply, unlike Sydney and Melbourne, Brisbane hasn't been seeing a very strong new listing environment. You can see that new listings in August this year were 0.1% higher than last year. They're pretty much bang on average for August. If we look at the average between 2018 and 2022, of course, at an individual area level, there are some differences, but certainly in regional Queensland as well, you can see that new listing volumes are reasonably low. If we look at total listing volumes, they're also low. So they're 3.8% lower than they were a year ago in Brisbane, and they're 35% lower than they were on average over that 5 years to 2022. So there's not a lot of stock coming on the market in Brisbane at the moment. People don't have a lot of choice. And there is a bit of that sense of fear of missing out. When a good property comes to the market, people really want to try and grab it because they don't know when something else appropriate is going to come to the market, but also how much higher prices are going to be by the time that property hits the market. Again, if you go to Sydney or Melbourne, a very different problem. They've got a lot more stock on the market and a lot more stock coming to the market, and people just aren't as motivated to purchase. If we look at sales volumes, so this year in August, sales volumes were 8.7% higher than they were last year. Between 2019 and 2024, only 2021 saw a higher number of sales in Brisbane than we saw this year. In regional Queensland, things are a bit more varied. You can see the Gold Coast actually had fewer sales than a year ago. Mackay Isaac with Sundays did too in central Queensland. But other areas like Toowoomba, Wide Bay, quite a big increase in sales volumes over that period of time. If we move to our measure of demand, so the number of inquiries per listing, they're higher over the year, both in Brisbane and in regional Queensland. Logan Bow Desert seeing the highest level of inquiries per listing, followed by the northern suburbs of Brisbane. Regionally, though, you can see on the Gold Coast, inquiries per listing is marginally lower than it was a year ago. Sunshine Coast, marginally higher than things were 12 months ago. And then if we look at how long properties are sitting on the market for, so days on market in Brisbane is 28 days. A year ago, it was 19 days. So things have, I mean, it's still a very short time on market, but things have certainly stretched and are staying on the market a little bit longer. Some of the heat has come out of the market conditions, and you can see certain areas where things have really increased dramatically. Queensland Outback's a bit of an outlier because it's such a big region, but Darling Downs, Maranoa, days on market there has more than doubled over the past year. You can see in the Moreton Bay North region, there's been quite a large increase in days on market there as well. So, again, it's very region specific. Some areas properties are still selling very quickly, but generally that days on market has increased. So what do we think is the outlook for the established housing market? Firstly, I think if we think about recent decades, prices have increased at a fairly rapid rate, and there's been four big drivers of that. And I think three of those big drivers are unlikely to be as strong going forward. Firstly, interest rates, they fell from about 18% in 1990 to around 2% a couple of years ago. That fall in interest rates dramatically increased borrowing capacities. Credit, it's a lot harder to get than it used to be. Banks want to know about how often you travel overseas. Are you planning to have kids? Private school fees. No one ever used to ask those questions. And that, depending on your answer to those questions, that may limit the amount of finance they're willing to give you. I also mentioned that employment participation's at a record high level. A lot of that's been driven by more women in the workforce, which has increased household incomes, and as a result has led to borrowing capacities increasing as well. Migration is still very strong. It's becoming a little bit more contentious. But if we look at three of those four drivers, they're probably not going to be as strong going forward. Now, that's not to say prices won't rise, but I think it's reasonable to expect prices won't rise as quickly as they have over recent years. We're still pretty, the level of demand for housing, though, is still quite strong, especially considering how quickly interest rates increased and how they have been at this highest level in 12 years since November of last year. That's reduced people's borrowing capacities, but we're still seeing a lot of people transacting. There's been a moderate increase in the volume of new properties coming to the market, and that is probably contributing to a slight slowing of price growth. And if that does continue, and early signs suggest that the start of spring has seen a lot of properties coming to the market, that will give buyers more choice. It will mean for vendors that they need to be more realistic on their price expectations because there's less fear of missing out. Even if it hasn't translated yet into a lot more properties on the market, if people have this feeling that there's going to be more stock, they'll be more inclined to not overpay for a property because they think, well, there's going to be other new stock coming to the market over the next couple of months, and it might be better, it might be more appropriate, and it might be more reasonably priced. So that's a really important message for your vendors out there at the moment. That high cost of new housing, it's likely to continue to see people preferencing existing homes. It's also likely to see people less inclined to do renovations or less inclined to buy properties that need major renovations. I talked about infill housing. We need more density. I don't necessarily think we need more high density in a lot of parts of the city, but some more medium density. But there's a lot of political and financial hurdles to achieving that. And I think the challenging rental market is likely to see more people that have the capacity to do it to become first home buyers. And we'll talk a little bit more about that as we go into the rental market slides. So looking at the rental market, over the past 3 months in Brisbane, house and unit rents were unchanged overall, but you can see certain markets, largely areas on the outskirts of the city, have continued to see rental growth, particularly for houses. Look at somewhere like Townsville, very strong growth in rents over the last 3 months for both houses and units. A bit more varied in some of the other markets. You can see there the Sunny Coast has seen a pullback in house rents over the last 3 months. If we have a look at how much it costs to rent, so advertised rents in regional Queensland are higher than advertised rents in Brisbane. Most of the rental stock in regional Queensland is in the Gold Coast and Sunshine Coast, and those markets are both more expensive than Brisbane. What is interesting, though, is even though Brisbane rents are up 6.9% over the past year, that is a step down from the 11.5% growth in rents the previous year. And also what's interesting is where the rental growth is strongest. Out of all the regions in Brisbane, the area with the weakest rental growth is the Brisbane inner city, probably the market you would think that most people are wanting to rent in. The strongest rental growth is in Ipswich. And this is what this high cost of renting does. It pushes people out to locations further away where renting is cheaper, particularly these overseas students that are coming into the country. If we have a look at house and unit rents, so house rents in Brisbane have increased at a stronger rate than unit rents, whereas in regional Queensland, it's the unit market where we've seen stronger rental growth over the past 12 months. In fact, you can see for houses, both regional Queensland and Brisbane houses have got an equivalent median price, but units in regional Queensland have a higher median price than units in Brisbane do. But we can see that rental yields are starting to fall in Brisbane because house price growth is so much stronger than rental growth. And it's a similar story in regional Queensland, but some of the rental returns available are very attractive, particularly in those regional townships. But even in parts of Brisbane, the unit rental yields are quite strong. If we look at rental supply, this is a theme we're seeing right across the country, that there's actually starting to be somewhat more stock becoming available. So the number of new rental listings in Brisbane was up 3.5% from a year ago. It's still low on a historic basis, and it's still below that 5-year average, but more stock coming to the market, giving people a little bit more choice. And when you look at the total number of rental listings in Brisbane, they're also higher than they were a year ago. Now, they're still well down on their 5-year average, but again, a bit more stock becoming available, giving people that are looking for rental accommodation more choice. And again, interestingly, some of those more inner city areas are where you're seeing more stock becoming available. And again, maybe that's a case that people simply can't afford the rent in those areas, and there's not the replacement people to come in and rent those properties either. And I talked earlier about vendors having to be more realistic on price point. Maybe landlords are increasingly having to be a bit more realistic on the prices they're asking for rents on their properties. In terms of rental inquiry, you can see it's also dropped a little bit in Brisbane, down 12.5% over the past year, whereas in regional Queensland, it's up 10%. The highest inquiries per listing at the moment is in Toowoomba, in regional Queensland. In Brisbane, it's in Logan Bow Desert. And you can actually see somewhere like Brisbane's inner city has one of the lowest numbers of inquiries per listing. So again, probably intuitively not where you would think the demand is strongest, but it's probably, again, very much an affordability story in the market at the moment. In terms of vacancy rates, they're still at very low levels, sitting at 1.2%. They have lifted a little bit from the lows. But again, the inner city areas are where we're seeing, of Brisbane, are where we're seeing some of the highest rental vacancy rates. Regionally, rental vacancy rates are still very high in Mackay Isaac with Sundays. Sunshine Coast vacancy rate is still extremely low, as is Toowoomba, as is Wide Bay. And then if we look at how long properties are sitting on the market for, there's been a slight increase over the past year. It's at 19 days in Brisbane. It was 18 days a year ago. Still well below that 5-year average level. But again, just maybe a sign that the market is easing off somewhat over the last probably 6 to 9 months. So what's the rental market outlook? There's been several factors that have really driven the rise in rental prices. During the pandemic, household sizes reduced. Now, the average household size fell from about 2.5 people to about 2.35 people, which doesn't sound like a lot, but when you calculate that out across all of the country, that creates a lot more demand for housing. At the same time, we had very low levels of new housing construction. And this is important because if you think back to, say, 2017, 2018, when we were building a lot of new housing, particularly new apartments, a lot of those apartments were being purchased by investors. And so once they completed, that was growing the rental pool. Now you think about what apartments are being built that are brand new. A lot of that stock is 2 and 3 bedroom apartments. A lot of it is being sold to owner occupiers. It means that the number of units you get in a new project is less, but it also means that you're not getting a lot of units coming into the rental market as that new construction comes to completion. And we're just getting generally less new construction because of labor costs and shortages and financing costs. At the same time, the population is growing really rapidly, so we need more housing. So it's quite the problem. We have seen rents continue to rise, but that rate of rental growth is slowing. Supply is still tight, but investment is definitely starting to lift. And if that does continue, that will mean that there's more stock available for rent and more competitive prices for people looking to find rental accommodation. As I said, the capacity to afford rent is really the challenge at the moment, and that's making people make sacrifices. And those sacrifices can be renting a smaller property than what you'd ideally like. That can be renting in a less ideal location. And in more dramatic situation, that can be bringing in a flatmate or moving back into a share house simply because you can't afford your rent yourself. And we know from flatmates.com.au, we are seeing a lot of that happening. How do we address what's happening in the rental market? On the supply side, you need more housing. Even if we fixed everything that was stopping new housing from being built right now, that would take several years for it to show up. So the other thing you can do is get more people investing in residential property, and that's certainly starting to happen, and that may increase further as interest rates start to fall. On the demand side, what can you do? You can lower the rate of migration. Now, it's already starting to slow, and we know that the federal government is trying to introduce caps on spots for university students. Whether they actually do that and whether it's successful remains to be seen. The other thing you can do is boost Commonwealth rental assistance, which they've done each of the past 2 years after no one touched it for about 20 years. And that's important because really, as the cost of renting increases, it's people that are on lower incomes that are really at risk of falling into homelessness. The other thing you can do is encourage or help more people to become first home buyers. And there is quite a lot of help for first home buyers. The problem is rents have increased so much that getting people to save a big enough deposit to exit the rental market and become a first home buyer is a challenge. But there's always people that do have that capacity. I think we do expect rents to continue to rise, albeit that pace is likely to slow a bit further. That should encourage more investors into the market, again, especially as interest rates come down and borrowing capacities increase. But I also think that that reduction in interest rates is going to encourage more people that are renting, even though it's going to cost them a premium to have a mortgage. There will be a larger cohort of people looking to do that and become an owner in their own right. So that brings me to the end of the presentation. I'm going to stop there and I'm going to have a look at the questions we have and see if there's any that we can answer. I've got one from 306 saying, sorry, what did the last screen mean? I do apologize. I don't know what that was. So question here, my thoughts on the impact the Olympics will have on Queensland market. Will we see a honeymoon period and then possibly a correction? Yeah, look, my personal view on the Olympics is the impact of the Olympics is probably somewhat overstated. People do point to what happened in Sydney, keeping in mind that the Sydney market was very flat for a long time leading up to the Olympics. And then we saw a national housing boom after the Olympics. I do think where you can tap into the Olympic benefit is with the new infrastructure that's being built to support the Olympics, albeit as someone that lives in Queensland, there hasn't been a huge amount of that actually announced. We haven't even settled on a stadium, or what we have settled on for a stadium is pretty embarrassing, and everyone's hoping that it will change. But I think if there are more announcements and more infrastructure upgrades, that's where people will see the impact of the Olympics. I think more generally, the Olympics will give more exposure to Queensland. Most people from outside of Australia, they know Sydney, they know Melbourne, they might have heard of Uluru, they've heard of the Great Barrier Reef, but they're probably not as aware of Brisbane and Southeast Queensland. Another question, given we have booms and busts all the time, feels like we've been in a boom for the longest period ever. What's the trigger for the next bust coming from within Australia or Queensland? I think That is true. We have had, particularly over the last 5 years, a really strong boom in prices. I think what's really changed though is we are getting more people buying and moving to Queensland than we typically have. And if you're selling out of Sydney and Melbourne and coming and buying in Queensland, prices seem pretty cheap. Yes, it's hard for us as locals because we can't compete with the buying power that someone that's sold out of Sydney or sold out of Melbourne does. In terms of what could trigger the bust, obviously, if the economy doesn't pick up, if we do head into a recession, I think that's certainly a bust. Maybe someone like the banking regulator, APRA, over controlling the market is potentially something that could bust the market as well. But realistically, I think the biggest risks of bust are things that no one sees coming, like the GFC, like a global pandemic. Those are the things that are really risky. If you think that something's going to cause a bust, you can actually plan for it. It's those unknown black swan events that are most at risk of busting the housing market or the economy on a broad scale. A question from Richard: Brisbane is more expensive than Melbourne median house prices. Do you think Brisbane is overheated? Yeah, this is a good question. So you'd have to go all the way back to 2002 to see prices in Brisbane higher than Melbourne. So it has been a long time since then. I think it's more a case that Melbourne is actually underheated. In Melbourne, you've got a lot of stock on the market. You've had people leaving Victoria during the pandemic. I look at Melbourne and go, I mean, Brisbane is expensive, but I look at it and say, well, Melbourne's actually pretty cheap at the moment. And if it wasn't for the state government in Victoria putting up taxes on investors, I think you'd see a lot more people trying to position themselves in Melbourne. And I think all Melbourne really needs is a moderation in that stock and interest rates to start coming down, and we'll start to see prices going up there again as well. I'd much rather live in Brisbane than Melbourne, though. So that's just my sort of personal opinion. Question or a comment here. I heard today that Labor is considering limiting the tax incentives to investors after a certain number of properties. What impact do you think that could have on both prices, but also the rental market? Yeah, look, they're very cagey on this. They've asked Treasury to do some modelling. We know the Labor Party has taken that to an election before and not been successful. I think I don't think they're going to scrap negative gearing and the capital gains tax discount outright, but I think that it's reasonable to expect that they might look at capping the number of properties you can have or something like that. Obviously, for people that own several properties, it might encourage them to sell out of the asset class. It might encourage people that have one property or however the limit of number is to stop continuing to get more and more properties. But I think the problem is you put more tax on things, you get less of it. So in terms of rental supply, unless you've got some other solution to create rental supply, it probably will reduce the availability of rental stock. What can local councils do to fast track responsible approvals for building? What can local government do to realistically release new land for development at reasonable cost levels? To be honest, the only real mechanism that local governments have for making things cheaper is removing things like planning fees and headworks charges and things like that. Obviously, getting approvals to people quicker will also help because the holding costs while you're waiting for a development approval, they do eat into your profits. But I think one of the things is the system is really messed up because people buy blocks of land, whether it be for houses or to develop apartments, and they try and get more housing on that land than what the local planning schemes allow for. So it becomes this cat and mouse game with the governments. The reality is if people just bought the land at a price that was commensurate with what's allowed to be built on there, we would have a lot more housing. But it becomes this game of trying to get more housing than what's allowable. In saying that, I think we definitely need to look at planning schemes and making things approved quicker, allowing more density in certain inner city areas in certain locations certainly makes sense, and trying to fast track this stuff as much as possible. But the only other real lever is to reduce all of those fees and charges on new development. Question here, is a smaller home or a more affordable style of home the future? Look, I think definitely, I mean, one of the things we're seeing three-bedroom houses are extremely prevalent across the market. But if you look at what developers largely build, it's 4 and 5 bedroom houses. But we are starting to see those smaller three-bedroom homes come back in. We're starting to see more two-bedroom townhouses being built. Now, that's probably not out of desire. I think most people would like to have a bigger home and more space, but it's out of necessity with where prices are that people are having to pare back their expectations and get those smaller houses. And I think, you know, you've got to get something that fits your budget. So I do think that we will be seeing smaller homes becoming more prevalent, particularly in that new housing space. And another question, what's something that you've seen in the market over the last 12 months that has surprised you? Look, I think I've been quite surprised at just how resilient the market has been over the last 12 months. I would have thought with interest rates increasing so rapidly and remaining at these elevated levels for such a long time that we would have seen not necessarily prices fall, but a much larger slowdown in price growth. I think one of the main reasons that hasn't happened is, firstly, there hasn't been much stock coming to the market. I think a big driver of that has been how tight the rental market has been. People have known that they can sell their property, but it's also almost a case of where do I go next? And for a lot of people, you have to transition through the rental market, but it's been so hard to do that because the availability of rental stock has been so tight that people have just sat on their hands and go, well, I'm not going to sell because yes, I can sell, but where am I going to live? I'm going to have to change schools with the kids. What am I going to do? As the rental market eases and availability improves, then perhaps we start to see more preparedness from people to put their properties on the market. That's certainly what we've seen over the last 12 months in places like Sydney and Melbourne. We are expecting price growth next year to slow from what we've seen this year. In saying that, lower interest rates could blow that out of the water as well, because we know as interest rates reduce, borrowing capacities do increase. Another question here, do we have any figures on properties being pulled from long-term rentals and converted into short-term Airbnb style accommodation? There's not really evidence of it, but I think with higher interest rates, with some of the law changes, people are looking to maximize the return they can get. And I think in certain locations across the country, Airbnb properties do offer you better returns. And in terms of whether or not local governments limit that from happening, they're already trying to do that in some parts of Queensland, limiting how long you can or how many nights you can let your property out for Airbnb. Whether or not it actually makes a huge difference, I guess, remains to be seen, but something you keep an eye on. I think we might, there's one more question. Is there any reduction or change to the pre-war home code? That is not something I'm aware of, sorry, so I can't answer that one off the top of my head. We might just pause there, and a quick poll is going to flash on your screen. So we would love to hear your feedback on how you found today's session when that comes up. If you'd like to listen to the session again or share it with your teams, the recording will be on the Customer Marketing Centre. And thank you for joining us, and hopefully you can join us next time. And good luck for the remainder of the year.